Good evening, ladies and gentlemen. You're watching India Tonight with me, Sumita Karir, and my colleague Ankita Saxena, who's joining us from our Mumbai studios. Ankita, it's a packed show today. We have a whole host of conversations also lined up along with stories. So, ladies and gentlemen, let's begin with some updates that are coming in from the Ministry of Commerce. Well, Union Commerce Minister Piyush Goyal lauded India's progress and cited IMF's projection on India's growth rates. He expressed confidence in India's growth trajectory and spoke on increased consumer spending due to GST reduction. Let's listen in to what the minister had to say.
अभी आए इंटरनेशनल मॉनेटरी फंड IMF के लेटेस्ट एस्टिमेट्स के द्वारा हमारे इस वर्ष की विकास की दरों में वृद्धि की गई है। IMF ने एस्टिमेट किया है कि अब भारत का ग्रोथ रेट 6.6% हो जाएगा, अगेन 6.4% एस्टिमेटेड अर्लियर। ये दर्शाता है कि भारत ने जिस प्रकार से अपनी अर्थव्यवस्था को मजबूत किया, देश में जो आज माहौल आत्मविश्वास से भरा है, जिस प्रकार से GST को घटाने से कंज्यूमर स्पेंडिंग बढ़ी है, जिस प्रकार से इंफ्रास्ट्रक्चर पे तेज गति से निवेश किया जा रहा है, इन सब का मल्टीप्लायर इफेक्ट, इस सब को जोड़ते हुए एक तरफ भारत तो तेज गति से आगे बढ़ रहा है, दूसरी तरफ दुनिया कि विकास यात्रा और कमजोर होते जा रही है। IMF का ही मानना है कि इस वर्ष की ग्लोबल ग्रोथ 3.2% रहेगी, पिछले वर्ष 3.3% थी, और भारत की ग्रोथ उससे लगभग 2 गुनी से ज्यादा रहेगी।
All right, moving on and talking about the International Monetary Fund that has raised India's growth forecast to 0.2 percentage point or to 6.6% from the 2025-26 fiscal year, as the country's strong growth momentum is seen offsetting the impact of high US tariffs on Indian goods. However, the IMF has lowered India's growth forecast by 0.2 percentage point to 6.2% for the next fiscal year. It is said in the report released in Washington. Now, IMF's upgrade, comes a week after World Bank raised its India growth forecast for 2025-26 to 6.5% from an earlier 6.3%, while trimming its projections for the next fiscal by 20 basis points to 6.3% due to US tariffs. Now, before we go to the guests, listen in to what the IMF had to say on the US economy and its fallout on the world as well as on China.
So the growth forecast contained in the World Economic Outlook shows that India remains one of the fastest growing economies in the world at 6.6%. But like other regions in the world, trade uncertainty is a key factor to the growth forecast. So while the growth forecast has been upgraded compared to when in April, it is a little bit slower compared to in prior years. And I think globally, we're looking very closely at the technology sector as a driver of the growth, including in India as well as consumer and business sentiments, which appear to be also important during this time when the economy is facing uncertainty.
Mr. Wu, thank you very much for your opening remarks and, of course, putting that question into perspective. But we do understand from the data that's been released by IMF. In fact, IMF has trimmed India's FY27 growth projection to 6.2%. So what's behind this moderation? Is it a reflection of global headwinds, or do you expect a normalization in domestic demand?
So let me bring in what our managing director said during her curtain raiser speech last week, which is that growth was better than feared, but less than needed globally. And if we unpack this a little bit, this reflects, sort of the IMF's view that medium-term growth has moved lower sequentially over the years globally, and of course, including in emerging markets and including in India as well, based on various global headwinds, based on the uncertainty that I described before, and the need for further structural reforms in order to bring up growth numbers.
Right. Also, in India's context, do you see the Reserve Bank's liquidity management steps striking the right balance between supporting growth and keeping the inflation in check? Does India require more liquidity at this juncture?
We think so. I will refer you to our Article 4 consultation later in the year and early next year for a more fulsome answer. But the global economy, including central banks like RBI, is facing challenges because while you have uncertainty shocks, on the other hand, there is also the possibility of global inflation. Now, inflation developments are different across different countries. And we believe that most central banks have been calibrating their policies, whether it is liquidity, whether it is interest rate, in a prudent manner. Let me just add that in the case of India, it is also important to remember that financial sector resilience is very important. So in the IMF's financial sector assessment program earlier this year for India, we have pointed out that banks and NBFCs, non-bank financial companies, have generally been resilient to shocks in the recent years. But it is also important to make sure that liquidity and regulatory policies ensure that the capital base of these institutions continue to be strengthened, in particular public sector banks. And also, it is important for public sector and private sector entities to be regulated in similar ways and for this alignment to occur. So all in all, we do think that the cyclical policies have been appropriate. There is obviously more work to be done to bolster the structural resilience of financial institutions in order to generate the credit that the economic growth requires.
Right, Mr. Wu. So structural strength and, of course, liquidity are some of the key issues that, of course, central banks across the world will have to look at strengthening. But let me also ask you about the global real GDP growth. Well, the IMF expects that at 3.2% for 2025. That's up from the July estimate of 3%. What's driving this more optimistic outlook? And is this recovery broad-based across advanced and emerging economies?
Yes, I think so. I think this growth upgrade, while modest, is broadly applicable. And one of the reasons is because in April, we were expecting very high tariff rates globally. Since then, I think through bilateral negotiations and multilateral discussions, the worst of the tariff rates has been avoided. Deals have been struck. And I think overall, the global economy has shown to be quite resilient. Now, in part, this is due to certain front-loading activities, right? So exports basically increasing in recent months ahead of the tariffs. But it's also due to the fact that the tariff rates were lower globally compared to what was anticipated in April. And let me just add that it's also the case that the financial sector, i.e. banks, financial markets, and non-banks have been overall resilient during this period. And so that helps support economic growth by easing financial conditions. In other words, businesses and households continue to find it relatively easy to obtain credit and borrow in order to fuel economic activities.
Right. Also, how is this the resilience of the U.S. economy shaping the global growth prospects? How much and how long do you think it will weigh on the global economy?
So that remains to be seen. I think it's fair to point out that what we have seen over the past half a year is that the U.S. economy is very large, very important, and quite flexible. So we have seen a marked labor market slowdown in the U.S. in recent times, but that has not necessarily impacted GDP growth greatly, right? So this comes down to the economy being flexible enough for reallocations to happen across different sectors, for productivity to be perhaps higher. And so the U.S. economy remains on a fairly solid footing at this moment. However, as I mentioned at the beginning, uncertainty is one area that we have seen in history to weigh down on confidence of businesses and consumers, and that could bite later on if geopolitical uncertainty, trade uncertainty, and general economic uncertainty are not resolved. And so when the US economy slows, US being the largest economy globally and major trading partners to most countries, that will have spillover effects and reverberations more globally as well.
Right, Mr. Wu, and we do expect this policy uncertainty in the United States to taper off to bring in more certainty. But let's also shift our focus on China. What is the IMF's assessment of China's growth trajectory, especially amidst its ongoing property sector crisis?
So like the US and the rest of the world, really, China's growth has been more resilient than was expected in April. And so part of this obviously has to do with still very robust export activities. And while the trade flows may have changed, so they are exporting less to the US, I think China is more active with trade with their regional partners, with other emerging market economies, right? So this also demonstrates that China has a certain degree of flexibility in terms of its economic performance. There are a couple of headwinds that you alluded to, which I think we are also closely looking at. I think the property market remains a headwind. The issues in the property market has not been fully resolved. And so growth will be further unleashed if these property market issues were to be resolved in an orderly and quickly manner. The second issue is that China has had a very high savings rate, which translates to low consumption rate for many years. And this is something that authorities are trying to move away from. So in other words, moving away from excess savings towards consumption, that very much remains a work in progress. And as you allude to, China's economic performance has profound impact on the Asia-Pacific region, as well as the rest of the world, because like the US, China is the second largest economy in the world, with manufacturing leading in manufacturing in many sectors, and has deep trade ties with many countries. So China's economic performance is profoundly linked to the world's economic performance. And we are offering advice to the authorities on the two issues in particular that I've mentioned before.
Right, Mr. Wu, also the IMF says financial stability risks remain rather elevated. What's driving these risks right now? Are they more linked to the geopolitical uncertainty, inflation, or tight monetary conditions? What are the key vulnerabilities that IMF is really watching most closely?
And so let me just point out that our latest global financial stability report, the title is Shifting Ground Beneath Calm, right? And the title suggests that basically there are trends in the financial sector that have been going on for a number of years that has increased the vulnerability of the global financial system. And these trends have really started after COVID, after pandemic. Of course, some of it has been exacerbated by geopolitical risk, as well as trade tensions. But some of it is also just development in specific to the financial sector. So more precisely, the three things that we're worried about, as documented in the Global Financial Stability Report, number one is that asset valuations appear quite stretched in certain segments. As we all know, financial markets have rallied pretty strongly. Stock markets globally have rallied by between 10 to 20% so far this year. Corporate bond spreads remain very tight. And a combination of this has led to financial conditions being very easy. As I mentioned before, this is actually positive for the economy in the sense that businesses and households can borrow more easily. However, we are all familiar with the concept that certain stocks, certain companies can be overvalued. And this is indeed one of the vulnerability that we see, which has continued since pretty much 2024. The second vulnerability is in sovereign bond markets. Many governments around the world are seeing high debt levels, high interest rate burdens, as well as a fiscal situation that they have yet to stabilize. In other words, after the pandemic, lots of spending has come from the government to boost economic activity. We believe and our fiscal monitor colleagues will discuss this morning in their press conference, that fiscal consolidation is urgently needed in many parts of the world. But how does it translate to financial sector risk? Fiscal concerns is primarily reflected in sovereign bond markets. And sovereign bond markets are important because they serve as benchmarks to many other financial markets, and sovereign bonds are quite often used as collateral in financial transactions. So the situation that we don't want to see is upheavals in these markets because of fiscal concerns that would link to broader issues in the financial system. For example, if the banking sector is very exposed to the sovereign, if they help hold a lot of bonds, and those bonds depreciate in value, the banking system can come under strains as well, right? So this is the second vulnerability in sovereign bond markets, and we think that it is urgent fiscal consolidation that's needed to resolve that risk. The third and final is the ongoing migration of financial intermediation and activities from banks to non-banks. Part of this is deliberate. After the crisis, it was recognized in crisis in 2008, 2009, it was recognized that there's too much risk concentrated in the banking sector. And so the diversification of risk outside of banking sector towards investment funds, pension funds, private equity is in a way a healthy development. And I think these non-banks have also provided the economy with new sources of funding and financing. However, they are rather opaque compared to the banking sector, and regulators do not have good information in many cases of the risk-taking and leverage activities of these institutions. And so the shift from banks to non-banks could be a healthy development, but it could also be a vulnerability if there are excessive risk-taking that are not being regulated properly. And so we think in the Financial Stability Report that this is a third vulnerability in the shifting ground that's exposing the financial system to more risk. Now, I'll say one final thing, which is that, amidst all of this risk, what do we advise countries to do? So I've already mentioned that fiscal consolidation is important because that will help ensure sovereign bond markets being resilient, and that is really quite fundamental to financial stability. On the shift to bank to non-banks, it is important to first ensure that the banking sector is very stable and sound. And because banks are the core of the financial system, their resilience is also fundamental to financial stability. On the non-bank side, while the activities of non-banks continue to grow, it is important to understand what those activities are and to regulate appropriately so that we eliminate the risk of excessive risk-taking through the non-bank sector. And quite frankly, related to my first point, their role in stretching asset valuations and making assets very highly valued. There are other recommendations in the Financial Stability Report that hopefully your audience will read. But those are some of the key policies to mitigate the vulnerabilities that I mentioned.
Right, Mr. Wu, you've made very imperative points with respect to risks that are related to the global markets are concerned, whether it's related to asset valuations being stretched or the bond market risks. But specifically asking about India, what metrics or risks and opportunities are you closely watching the most with respect to this particular geography that is India?
Thank you for that question. I think like other large emerging economies, there are metrics on both on the macroeconomic side as well as on the financial side that we typically look at when doing assessments. So on the macroeconomic side, obviously, as I mentioned before, budget deficits, whether the fiscal picture is healthy, is a key metric. The current account and trade balance, whether a country is persistently running large current account deficits, that's also an important metric in assessing risks as well as opportunities in the future. On the financial side, it is instructive often for us to look at capital flows, whether those are surging or retracing at a rather fast pace and being volatile. If there's excessive volatility in capital flows, that usually suggests that there are more risks. But capital flows can also be very opportunity driven. For example, foreign direct investments that are typically more stable, that leads to employment opportunities in the receiving country. I think those are very much needed to be revived during times like this. And then finally, as financial stability people, I always start my assessment by looking at the banking sector, in particular, whether the banking system has enough capital and liquidity. So whether capital ratios are high compared to peers, as well as their liquidity positions. In other words, what kind of liquidity shocks can the banking system withstand when there are, for example, global shocks or there are adverse events occurring in the country. And as I mentioned before, our February financial sector assessment program has shown that Indian banks and NBFCs, to that extent, has made strides since a few years ago in improving their resilience in this regard.
All right. Thank you very much for listing out those opportunities and risks, Mr. Wu. And thank you very much once again for taking the time out and speaking to us here on ET Now.